I don't think that the Basel III Accords were particularly important to the increase in the price of gold, because the Basel III banking accords primarily affected private sector banks. It being gold was made a tier one asset for banks like Barclays, Bank of America, Citicorp, Daiichi Kangyo, those types of global banks. The buyers have been foreign central banks. I do believe that the Basel III Accords will be important to the gold price going forward when the private sector steps up to the extent that the public sector has in the gold trade. Other aspects of the Basel III banking accord probably indirectly will benefit gold too, in the sense that although the rules around gold were made less restrictive, there were other rules around the characterization of bank reserves. And in particular, the differentiation in reserves against debt instruments that were held for sale versus held to maturity. Accords that allow banks to extend and pretend around time losses in their portfolios that I think will destabilize the economy a bit, particularly in crisis, and as a consequence, likely, unfortunately, in this case, help gold. Silver, in my experience, has been more of a speculative instrument than gold. And silver tends to outperform gold towards the middle or the end of a precious metals bull market. In my experience, precious metals bull markets are led by gold because the first buyer is the fear buyer. Precious metals oscillates between greed and fear, with the fear buyer kicking off the move, and then the momentum established by the fear buyer bringing the greed buyer in. Silver, because I suspect of its lower unit cost, when the generalist money comes down into the precious metal space, that money eventually causes silver to outperform gold. And by the way, when the silver bull market starts, you're not going to need Rick Rule to tell you it's here. You're not going to see a move from 33 to 34. When silver moves, it really truly moves. But normally that move takes a while to establish itself. And normally what establishes it is momentum in gold. I suspect that people are, by people, I mean largely institutional investors, are expressing skepticism around the precious metals bull market. And the easiest way for them to express that dissatisfaction is on the New York Stock Exchange. The best vehicle for expressing either your support or your lack of support for silver on a leverage basis in equities markets is the New York Stock Exchange, and hence PSLV. PSLV is experiencing a war between those who buy the precious metals narrative and those who don't, much to my amusement. You know, there's a lot of people who are against shorts, primarily long. I love a big short position against something I'm in favor of. That's a position that has to be bought. And it's up to reality whether that position needs to be bought higher or lower. Earlier in my career, when I was more overtly a stock promoter, there was nothing in the world I liked more than a good short position. In some investments, by the way, silver related, often Pan American Silver and the Silver Standard in particular, we delivered quasi-religious experiences to the short community. And I suspect that if people end up being too short PSLV, that they could experience just exactly that kind of religious experience. There's nothing in the world worse than being caught on the wrong side of a short trap. I don't believe that gold will never be sold again. I believe that gold will be a form of liquidity for central banks. And if gold does extremely well relative to fiat currencies, I suspect that many of the banks will need to access the liquidity of gold to fund politically expedient domestic spending programs. I understand the idea that as a position becomes more concentrated, that the price volatility among the remaining inventory on the market becomes more volatile. I would suggest that volatility will come into the gold space when you see the retail investor return to gold. What you've seen really for 3 or 4 years has been a predominance of central bank buying. Most months in the last 5 years, the flow of funds in terms of precious metals oriented ETFs has been negative, which is to say retail investors have been dishoarding gold at the same time that institutional investors, at least foreign central banks, have been hoarding gold. The exception to that, of course, would be the Chinese retail market, which has been consistent buyers of precious metals. If you own an asset class that goes up in price faster than the deterioration of the purchasing power of your currency, you in fact benefit. If you look back at the gold price in the period 2000 until today, over 25 years, the gold price has escalated, at least in nominal terms, in US dollar terms, between 8.5% and 9% per annum. While I believe that the deterioration of the purchasing power of the US dollar is substantially higher than the rate ascribed to it by the CPI, I would still suggest to you that in the year 2000 to the year 2025, that holders of physical precious metals experienced real gains in purchasing power in excess of inflation. I suspect that that trend continues. If one looks at history as a guide, in the period 1970 to 1980, according to the according to the Office of Management and Budget, the US dollar lost 75% of its purchasing power. During that same period, the gold price rose 30-fold. Obviously, gold holders in the period 1970 to 1980 increased their purchasing power during a time of real economic turmoil, where most of their neighbors experienced a deteriorating material standard of living. The other factor for me is nebulous. What I do is I pretend the money's in cash, and I think about where I'd allocate it. Let's say that I bought a bunch of silver right now at $34 an ounce. And let's say 2 years from now, it's at $50 an ounce. And let's say, just for fun, to make the math simple, I had 1,000 ounces. I look at the $50,000, and first of all, I look at the tax aspect of what it would cost me to get the $50,000. In other words, the capital gains tax from $34 to $50 an ounce. And I think what I would like to do with the remaining money. Is there an apartment building, a small apartment building that I could use to put a down payment on? Is there a stock that I think is substantially undervalued? In other words, the decision for me, at least on an annual basis, is what is the highest and best use of the resultant after-tax capital on every asset class I own. Well, first of all, I don't think they're going to go to a gold-backed currency. A gold-backed currency imposes a discipline on politicians, and politicians want raw power. The idea that there would be a discipline imposed on the politicians from the market or from gold seems to be unconscionable from their point of view. That's not what they want. Certainly, if you had a circumstance where some money was semi-good, which is to say it was backed by gold, as opposed to an unbacked currency, good currency always drives out bad currency. That's happened from the beginning of time. Unfortunately, I don't see good currency, at least good public currency, being available in my lifetime. There's a lot of gold in seawater, and we don't mine it because the energy expenditure to recover the gold, which is to say to precipitate off the water, would be too costly. The second thing is that when you concentrate a whole bunch of elements besides gold, some of them are fairly toxic. And the brines that you would generate as a consequence of precipitating the gold out of seawater, the disposal of that would be, first of all, dangerous and secondly, expensive. But the truth is that the concentrations of gold in seawater are so low that given today's energy costs, it would be economically efficient to concentrate it. One trend that we're seeing in the mining business, not just gold, but really across the mining business, is the very rapid increase of social rents on mining. Government royalties, government taxes, government off-site concessions, which is to say the expenditure by companies on infrastructure off the mine site that would normally be the responsibility of government. Remember that governments exist to transfer, which means they have to steal that which they transfer. Mines are fixed targets, and capital-intensive targets. They're an extremely attractive target for governments. The Mexican government would rather that they stole from the Mexican miners. The American government would rather that they stole from the miners, and the Canadian government would rather that they stole from the miners. The idea that there would be a common unity among thieves, which is to say the Mexican, the American, the Canadian government, seems very unlikely to me. My hope would be that we graduate to a plethora of digital currencies. I'm a consumer of currencies. I use the Australian dollar, the New Zealand dollar, the American dollar, the Canadian dollar, the Chilean peso. And to the extent that there's a whole bunch of smart geeks in some lab trying to design a better currency for me, I'm all for it. My suspicion is that the distributed ledger eventually will be a technology that's adopted really throughout commerce. I think, as an example, that home titles ultimately will be recorded and transferred on a digital ledger, and there's no reason why currencies shouldn't do that too. And there's no particular reason I can think of, other than the greed and larceny of host governments, that any issuer has a monopoly on a medium of exchange or store of value. And I would like, as an example myself, to be able to transact in fractional gold and silver. When I go to Starbucks to buy a cup of coffee, I'd like to have my account debited and their account credited for a fraction of a gram of gold in exchange for my coffee in the morning. And I think that that will occur in my lifetime. There was a time when I was very concerned about any service that would require a picture of me taken. I have now seen the pictures that the government has of me when I cross borders. It's over. That doesn't mean that I wouldn't like to have some physical gold and silver outside the system in some fashion, so that to the extent that there were real system failures, or to the extent that the system decided that they wanted to victimize me, that I wouldn't have the medium for self-protection. I would be very cautious in the context of this discussion about how that physical gold and silver were stored. Many people who feel like I do have an unfortunate tendency to engage in what I call backyard gardening, which is to say they take physical delivery of gold and silver, and then they try and hide it around the house. You need some form of storage that's better than that, because if you do midnight gardening, you expose yourself to a whole different set of risks. Not your government, but your so-called friends or your neighbors who might decide that they want your gold and silver more than they want you to have it. How much liquidity in a crisis do you need? Let's assume that a bag of junk silver, as an example, when you went to acquire something with the silver, involved the merchant, because of a lack of liquidity, scalping you for 10% of the value of your silver, as opposed to having a digital bank, central bank digital currency, where the government canceled your currency altogether. Would you rather accept a 10 or 12% markdown, or would you be more comfortable with 100% markdown? I'm not unattracted to the recent drilling results of BlackRock, although I don't own it. High-grade deposits, high-grade epithermal deposits tend to be fairly small. And I don't see in either case enough gross ounces to really attract me. What I found in my life is that small mines and big mines really have the same amount of risk. But a small mine can only ever make you a small amount of money, while a big mine can make you a lot of money. Given that you take the risks inherent in mining, I prefer big deposits. To the extent that BlackRock begins to knock on 100 million ounces, I'll become interested. But at present, these small high-grade deposits are of less interest to me, after having played with them on and off for 50 years.